Up in today's show, the S&P 500 falls the most since April on the surprise US credit rating downgrade from Fitch. I'll dig deeper into what they said and what this likely means for the stock market and bond market, as well as the long-term prospects for the US economy, and how US's credit rating compares to other countries, what JP Morgan CEO said about it, the sell signal the stock market just got, how Q2 earnings season is tracking, and finally go over all the most important charts, showing you some emerging technical patterns out there. Welcome back to the Click Capital Daily Show, everybody. My name's Jared. I'm going to run you through all the most important news, data, and charts from the markets today. And don't the financial markets keep it interesting and challenging for us all? On the back of that surprise credit downgrade from Fitch last night on US debt, that spooked the stock market a little bit here today, and especially the Nasdaq, with semiconductors leading the way on the downside. And then we did actually see a bit of a defensive rotation into healthcare, consumer defensive, and utilities, with a bit of bearish breadth across the rest of the market. And so the big news today was the downgrade in the debt from Fitch, taking US's credit rating from AAA to AA+. And so there's three big credit rating agencies out there, Fitch, Moody's, and S&P. The last time we saw this big downgrade was 12 years ago, back in 2011, from Standard & Poor's, which did the same thing, took it from AAA to AA. And now I've just got Fitch, but we've still got Moody's with the AAA outlook. And so here's the statement from Fitch Ratings themselves, releasing it a little bit after 5 p.m. last night Eastern Time. And it's a pretty in-depth statement with a lot of details in there. So instead of reading the whole thing out to you, I just pasted it into ChatGPT and asked it to summarize the whole thing into one simple paragraph a 12-year-old could understand. And so here's a quick summary of exactly what Fitch is trying to tell us. So Fitch Ratings is a big company that judges how reliable different countries are at paying back their money. They've downgraded the rating for the United States. This means they believe the US is slightly riskier to lend money to than before. The reasons for this is because the US government is spending more money than it is earning, increasing the national debt, and there's concern about how the government is being run, especially in handling this debt. Even though some cuts have been made to the spending, Fitch believes they're not enough to significantly improve the situation. If things continue this way, the debt could keep growing and put the US at a greater risk if the economy faces shocks. However, the US strengths, like its large, well-developed economy and widespread use of the US dollar globally, help it manage these risks. Fitch also thinks the US economy may go into a mild recession, meaning it could shrink a little towards the end of 23 and the beginning of 24. And so while this is not new information, nothing new has happened, it's hard to deny what they're saying, and it is true about the deteriorating fiscal management of the country, the overspending by politicians, and at some point that is going to have to hurt. And the government gets it notoriously wrong for projecting what their budget will be going into the future. If you look back in 2007, the Congressional Budget Office projected that US debt as a share of gross domestic product would be 32% in 2011. When we got to 2011, it was actually 69%. In 2023, they projected it would be 76%. Here we are today, it's 98%, and in 2029, they're actually projecting 108%. So that's probably going to be wrong. And that total public debt, already projected to hit $33 trillion by Christmas, is probably going to keep accelerating on the upside. And there's a lot of things that have gone into this over the last 10, 20 years. Not just general mismanagement and overspending, but also a bunch of global wars has significantly contributed to that debt pile. And that's accelerated over the last couple of years as the federal deficit, as a percentage of GDP, continues to trend in the wrong direction. And so whilst now federal debt of the states as a percentage of GDP is above World War II levels, the real problem isn't today, it's where it's going in the future, with that projected to go above 200% by 2050. And let's not forget how conservative all these projections actually turned out to be, and massively wrong. And so while I think it's justified for the credit rating agencies to downgrade the debt, now giving the United States a lower credit rating than actually 10 other developed countries from around the world, right now in the short term, it's probably not going to give a huge material impact to the Treasury and bond market, because most Treasury holders are going to continue to hold. They still have mandates and index funds that will continue to hold US government debt, and I don't think anybody's questioning the US government as to whether they can pay back their debt anytime soon or not. Like I said, it's more of an effect on the long term, and if the US government doesn't change their spending behavior, or have to greatly increase tax, or figure out a way how to tax the 1%, or stop spending so much money overseas, or really help drive big economic growth, or any combination thereof, the way the US government is going with its spending in 10, 20 years, it could be on its path to a BBB rating, which is junk bond status, and significantly increase the cost to repay all that debt. And that could be exacerbated if the likes of China and others are successful with knocking the US dollar from its global reserve currency status, because that's really what keeps the States kind of being able to inflate its way and print its way out of this issue for now. But for right now, I agree with what JP Morgan CEO Jamie Dimon says, that it doesn't really matter because it's the market and not rating agencies that determine borrowing costs. So Fitch is just one rating agency. They don't have complete leverage over the US economy and the huge US stock market. And like Jamie says, it's governments, companies, and individuals that lend to each other, not the rating agencies. And so there won't be a big exodus out of US Treasury government bonds. It's just more of a justified long-term marking down on the US government debt rating, and could actually be a good thing as it kind of shines a spotlight on it for everyone to look at, and might just do the trick at keeping politicians honest and stop selling out our future for their own current day votes, and stop spending needless trillions overseas when it could be spent fixing domestic infrastructure, among other things. So just looking at how US government bond yields reacted today, up the front there wasn't much of a change, with the 2-year yield still trading at 4.88. We did see a bit of steepening in the curve in the back end though, with the 10-year government yield rallying up to new year-to-date highs 4.12%, and more so in the 30-year yield as well, getting up to 4.20. So that's logically what you'd expect to happen to bond yields when you do get a credit rating downgrade, because in theory those bonds become more risky, so investors should demand a higher rate for the compensation for that risk. However, going back to August 2011, last time the US got a major credit rating downgrade, the 10-year yield actually fell a lot, quickly from the high 2s down to 1.7% in a little under 2 months. However, the economy was a bit different back then. It was still on shaky ground coming out of GFC. There was still higher unemployment, big problems in Europe, and that kind of just exacerbated those fears, and there was a bit of a flight to safety. And a lot of people bought bonds, and hence we saw yields sell off. And we also saw that play out in the S&P 500, with the stock market falling about 20% in that time as well back then. And so that flight to safety also caused a big rip in the TLT ETF from the end of July, going from 95 getting up to 125 just a few months later. But fast forward today, we seem to be getting the opposite reaction initially here, with those long duration bond yields rising. We saw TLT come off here today. It is technically oversold, and we did get a little bit of a dip by action. And looking at the S&P 500 on a weekly chart here, we have come up against this resistance zone at 4,600. We've been in this big multi-month parabolic rise. So the question is, will this start a bigger correction in the stock market? Even if it doesn't materially change how funds are invested in treasuries, it may have just spooked the market enough in order to cause a bit of selling, which could then feed onto itself and then turn into a bit of profit taking, and then next thing before we know it, we're back at 4,200 here. And so we've even got some of the most famous bulls this year, like Fundstrap's Tom Lee, saying investors should be wary of a potential stock market sell-off. And he noted we also just got the Tom DeMark 13 count sell signal. In the last 3 times we got those 13 counts, the market did pull back 9, 8 and 19%. And this is still with a macro backdrop that isn't bullish across the board. We do have inflation coming down and a tight jobs market, but those higher rates are already eating into the economy, with a surge in bankruptcies and still some pressures in the banking and real estate sectors, especially in commercial real estate, which is coming up to a big $1 trillion refinancing wall next year. However, contrasting that, we are having a pretty good Q2 earnings season, with a little bit above average companies beating expectations, with 334 of the S&P 500 companies having reported so far. Almost 80% of them have beat. Long-term average is around 77%. The bar was set low. Overall, companies were expected to deliver their third quarterly earnings contraction, down 9% year over year. And the price action over the coming days will be pretty important. As you can see here, we've got the Nasdaq just above its 50-day VWAP and coming up to this trend line as well. We've had it in place since the start of March, and we sold off here on a bit of volume today. So stick with me, I'll take you through the rest of the data today, and I'll get back into the charts and we'll look at some key stocks and have a look at some technical patterns forming. Not much out in economic data today. We did get that ADP employment change from the States coming in a lot higher than expected, 324,000 jobs, and oil inventory coming in a lot lower than expected, but the oil market probably already saw that coming. That's why it's been so strong lately. The news of the credit rating downgrade of the States today didn't change Fed Fund futures market from giving a 17% chance the Fed will raise rates next month. And the Fear and Greed Index lost its extreme greed reading for the first time in over a month. And pretty busy day in the options market, 45.6 million contracts traded and 54% calls. And looking at the dark pool index, since it's been diverging so much from the stock market, looks like they may be getting prepared for a larger pullback here. And corporate insiders as well, getting back to selling significantly more than they're buying. 150 sales yesterday versus 45 purchases. So back into the charts, still got the S&P 500 just above 4,500. Wasn't that big of a reaction across the market. It's only down 1.3%. It was a bit of bearish breadth across the board with all indices down. Nasdaq down the most at 2.19%, and international stock indices coming off a bit hard as well. Got a little bit of a perk up in the VIX index here today, a bit above 16, and a little bit of a flattening in the term structure of the volatility market, but still in a normal contango state where we've got up the front lower than out the back. How you know if the market's really starting to get worried is when we'll see this VIX 9-day go above the VIX 30-day, and then the more worried it gets for immediate volatility, the higher we'll see up the front go. So right now it's not that worried, but could still be pricing in some moves ahead, and we saw that in the volatility risk premium. Jumping a bit here today now at 6.7 points above realized, and a bit of a trendline break in the move versus VIX index spread. And so for a little while now, we've had bonds a lot more volatile than stocks. However, it looks like stock market volatility caught up a little bit here today. And just taking you out to a long-term 3-month chart, we can see this spread had reached levels not seen since the GFC. And so maybe we have now seen a turn in this spread and a top, which would mean more volatility upcoming for stocks. And the price of out of the money put options is still high with the skew index 145 and a big deterioration in short-term breadth today. Now about half of all stocks above their 20-day average. We've still got some long-term breadth there with 67% of stocks above their long-term 200-day average, and a bit of a deterioration in stocks making new highs, with the amount of stocks making new lows on the Nasdaq actually outpacing the amount of stocks making new highs 50 to 40. And a bit of a turn down in the growth versus defensive stock sectors on a bit of a bearish divergence here, and especially so in that high beta versus low volatility. That's that defensive rotation. You can see play out in the growth versus value spread as well, also below its 50-day VWAP. But like I said, the market's not that worried just yet because we can still see credit spreads holding up in the spread chart of high yield bonds versus treasury bonds still above their 50-day, and high yield bonds only finishing their day down 43 basis points. Those higher bond yields helped the dollar finish up today above 102. And like I said, there's no real immediate fears that the US government can't pay back its debt, and that's why people aren't abandoning ship and jumping over to Bitcoin, because Bitcoin actually finished down today. So Bitcoin's marketed as a good hedge against traditional finance system instability. However, it doesn't look like Bitcoin is getting too excited by that credit rating downgrade. The higher dollar did put a bit of pressure on commodity prices today, finishing down 1.5% across the board. I would have thought gold would have liked that news of the credit rating downgrade a bit more and a little bit of a flight to safety, but apparently not, and the strong dollar's had a bit of an effect on that as well. Seems to bounce off 2,000 an ounce a little bit here. We'll see whether we can hold the 50-day VWAP, and who knows, any day we may come up and test these new all-time highs. And just looking at stock sectors today, red across the board except for the defensive stuff. Healthcare actually finished up, so did consumer staples, and flat and utilities. The hardest hit sectors were clean energy, recent IPOs, semiconductors down 3.6%, sitting right at their 50-day VWAP, and ARC as well down 5.5%. So it was a bit of an exodus out of that high beta, high growth stuff that's been performing really well this last couple of months. And just to look at our sector trends table indicator, we can see we're completely red across the board in all 25 sectors that we monitor, with them all being below their 5-day moving average, and a bit over half of them below their 20-day moving average here. So we're already in a short-term pullback. The question is whether this turns into a bit more of a medium-term pullback, and we get a lot of sectors below their 50-day average. Currently only 3, and we still have the majority of them above their long-term 200-day average as well. Over to popular stocks, and BlackRock, like many others, sitting right at its 50-day. Bit of a pullback in JP Morgan, and we've got the big one tomorrow afternoon, Apple earnings. And Apple just broke down through this tight trend line that's basically been in place all year. And this is a big one I'll be watching tomorrow, because this could really kick the market off in either direction. We could rip higher and it just turns out this was another buy the dip opportunity, or who knows, we might see Apple down 5-7% and that really gets things going down on the downside. So there's a bit of hard selling across the board in mega cap tech. Microsoft down 2.6%. Got Amazon earnings out tomorrow. It's already pulled back a bit here underneath its 50 on this bearish divergence. And the semis were real sensitive to that selling today. NVDA down almost 5%, and it too sitting right at its 50-day. Tesla dipping a bit down there as well, and AMD reversing course after yesterday's earnings. Initially a good reaction from the market, then we put in a big bearish engulfing candle today. There's that big correction in Tupperware, down 31% today. Looks like they may have just come out with earnings, and the market's marking them down another 8.7% after hours. And a bit of weakness across the meme space in general, with Carvana being the only stock that finished up 5.5% on its highs here. Active today, we had earnings from Shopify, down 7.4%, DoorDash up 4.7% after hours, and PayPal doing a little bit worse, down 7% after hours on the back of their earnings. And the banks didn't like those higher rates today like they normally do, with them all being sold off a little bit. There's a quick look at our S&P 500 oscillator, currently at 46.3, and diving pretty significantly here today on a huge bearish divergence. Okay, so to sum it up, a bit of a technical junction here for stocks. We've got the Nasdaq pulling right back to its 50-day and a lot of those mega cap techs, as I just showed you, with Apple, the biggest stock in the market, actually breaking down through that tight parabolic trend line it's had all year, and the earnings tomorrow will be the big one. Kind of doesn't matter what numbers they come out with and guidance and exciting talk about AI and that. The biggest thing is how the market reacts. And so for this to turn into a bigger pullback, we really need to see a big negative reaction to Apple's earnings regardless of the numbers. We need to see it trade below this white line, the 50-day VWAP, which will then make the NASDAQ index, the Qs, do the same. And then we could be on the start of something bigger, a medium-term pullback. And just looking at that weekly chart of the NASDAQ, it shouldn't be all that surprising if we do get a pullback. The question is, do we get a big 50% pullback from this whole move we've had this year, taking us back down to 320s on the Qs, and around 4,200 on the S&P 500 would be a 50% pullback from this year's move. And we are coming into that seasonally weak period for the stock market. So like I said, nothing new has happened with the credit rating downgrade. It's just one credit agency making note that the whole debt ceiling debacle the US Congress does every couple of years does affect the credit rating. And I think they're justified in doing that. And it should shine a light on what the politicians are doing and try and motivate them to change course and not send the US debt to junk bond status in 10-20 years, and it's going to require some big structural changes. So while there shouldn't be any material changes in the amount of money invested in treasuries, it could just be a bit of a tipping point technically for the stock market to have that correction pullback. But like I said, we'll have to see how the market reacts to Apple earnings tomorrow and whether we can get that follow through on the downside. So that's all for this interesting day in the markets. Thanks very much for sticking with me, and make sure you come back to the Click Capital channel tomorrow afternoon, where I'll be diving into Apple's earnings and, more importantly, the market reaction to it. Thanks very much, and I'll see you then.